not payable immediately after the death of the first spouse. However, is postponed up until or carried over up until the death of the second spouse, right? So if you die and you leave immovable property to your husband or to your wife, that person will not immediately be required to pay a CGT. The CGT will be postponed up until when the second spouse dies, right? So that is the benefit number one. But if you leave your property to a company or to a trust, that exemption does not apply. So upon that whatever asset needs to be disposed, the CGT will be applicable or will be payable. And then also when it comes to your kids, when your kids inherit your immovable property, which is a house, they also don't pay the CGT when you die, when they inherit. They will only pay it if they decide to dispose of it. Like, for example, if they choose to sell it. But if you leave a house to your kids and they decide to stay in it or rent it out or whatever way, as long as they don't dispose of it in a form of transferring ownership to another person or selling it, they are also exempted from paying CGT. But a company and a trust, that exemption does not apply. No. It's not only for the primary residence, there is an additional exemption of 2 million.
Uh,
Like maybe let's say maybe it's a property, it's a residential property of 2 million, right? And then they want to dispose of it or whatever. Barking, the 2 million, the first 2 million of the value is exempted from CGT, right? Sorry, the primary residence. You mean in the case of a person that has multiple properties? There's nothing. Look, remember a CGT. Yes, from my knowledge, right?
can I come in if sorry to sound rude, can I come in please? Is it fine? Yeah, on this and then Irene can continue, please. Um, um, Guys, the tax implications I alluded earlier. When someone passes on, the only rollover that Irene is speaking about, it's only applicable to the spouse. Okay. Because the principle is that there are three parties that exist, right, when someone passes on. Let's start when you are alive, let's say until today, God forbid, and then tomorrow he passes on. On today, until today, you are deemed to have sold an asset. Okay. If you pass on tomorrow, you are deemed to have sold your assets today. Right. Now, if that, then there's a new taxpayer kicks in called deceased estate. Right. Then, if in that winding up of the estate, you nominated your wife, which is a surviving spouse, that will inherit this particular assets, and that assets is subjected to CGT, which is capital gain tax, then there will be a rollover. Okay. However, if the assets are going to be distributed to any other beneficiary other than the surviving spouse, then that CGT that happens today kicks in. Are you with me? Then the kids or whoever is going to inherit, be it a trust or a company or whoever, is going to inherit the assets at the market value. So it means for tax purposes, it's as if I bought that assets today. If I were to inherit from you having passed on, then it means it's as if I bought the assets for the value that it's worth today. Because whoever passed on, you would have paid tax at the value of today. So that is pretty much how you're going to be able to transfer the assets. The only rollover that is there it's when I'm transferring it to the surviving spouse. And that is why tax plan is very, very important to assess some of these assets where if some of the assets exist that have got a potential capital gain tax purposes, sometimes it's advisable to transfer them to the surviving spouse so that you don't have the capital gain tax implications. I just wanted to clarify that, and yeah, you guys can continue. Thanks.
Okay. It's just that I've been trying to look for that section that I was referring to. Maybe I could have got it wrong, but I'll still go and research it. It's just that now I don't have the time. Maybe let me get my laptop and check while I'm speaking, because what I know, I could be wrong. I'll go and as an attorney, we like to refer to authorities. So when you speak about something, we like to refer to the relevant legislation that makes provision for what we are referring to. But then, according to my knowledge, the capital gain tax is payable by the if they decide to dispose of the asset, right? Meaning upon inheritance. And I'm saying this referring to both residential and non-residential, right? When they inherited, I could be wrong, but I'm trying to log in onto my laptop and see if I can find an authority. If when they inherited, the CGT is not immediately payable upon them inheriting it. It only becomes applicable when they, meaning maybe when they sell it, or they choose to transfer ownership to someone else, or even a trust. So I'm trying to check here, ne? But while we're still on that issue, we can park that one. So another one that I wanted to speak about regarding the estate planning, ne, is the issue of the trust. Again, there are two types of trust. I'm sure a lot of people know now: a testamentary trust and an inter vivos, right? So there are two types of beneficiaries that you can have in a trust, like or a trust can have discretionary trust, where the trustees make a decision how to distribute whatever benefits to the beneficiaries. Or there are two types of beneficiaries. There are those beneficiaries that can only benefit from that can benefit from both the capital and the income of the trust, and there are those beneficiaries that can only benefit from the income of the trust. For example, you maybe, let's say, as a founder, you donate 2 million rands in cash to a trust, right? And you have a list of beneficiaries. Maybe let's say your kids and your spouse are the ones who can benefit from both the capital, which is the 2 million that you've donated, and the income that the trust is going to generate from that 2 million. Then maybe let's say you decide to put your siblings, maybe your sisters, your brothers, to say these ones, they can only benefit from the income that the trust makes. Let's say maybe you donate 2 million and the trustees decide to invest the 2 million, and then at the end of the year, the 2 million maybe has made an income of 500,000, meaning now in the trust we have 2.5 million worth of cash or assets, whichever way you want to put it. Then you find that the 2 million, which is a capital, it's only a certain category of beneficiaries that you've nominated, or these ones, they can benefit from both the capital and the income. And then there's another category of beneficiaries that you will list in your trustee to say these ones will only benefit if there is income in the trust, if the trust was able to generate income. So again, sorry guys, can someone speak while I'm trying to get an authority for what I was referring to in terms of the capital gains tax? I'll come back.
Can I contribute something? Hi everyone, hope you are good. Okay, when it comes to estate planning, right? I love what everyone is saying of opening a trust or opening a company. Okay, I'm gonna look at it in point of view of an accountant, I'm an accountant. So trust, first of all. Okay. On what was being discussed now. Okay, fine. CGT arises when there is a sale of capital asset, which is property. Yes. Capital asset, which is property, right? In the estate. You're selling the house, for example, then CGT will arise, right? So what Mr. Matoba was saying was correct. Once the principal owner, whether it's a business or a person, passes away and property is transferred to someone else, there will be an implementation, there will be an arisal of CGT in that sense. So it will come into effect. Okay, if the exception is there, we've all spoken about it. It's 2 million. That's why I don't want to go back to information that you already said. So the Lentuka, the primary exemption is there, which is 2 million rands on primary residence, basically, right? Now, since we are on the companies and trust, answer your question before I jump. Just I also don't want to lose my train of thought, right? No problem. Okay. So when you are moving your house from your kids, after death, that is, your kids from your parents to your kids after death, what normally happens is that everything that you own is taken to estate duties where estate lawyers will deal with it, right? And there it will move down to your kids. After they have dealt with everything that you owed has been paid, and everything that is left behind, then it goes down to your kids, right? So I'll come back to that one. Can I go back to my train of thought before I forget? Okay. No problem. I was dealing with a case like this last year where I had a client who was asking about estate planning. So from the point of an accountant, what we do is we look at SARS. A company has a tax of 27% currently. They've reduced it to 27% annual tax. What is taxed in a company? A trust is taxed at 45%. So what we do as accountants is that we advise our people that open a trust, right? After opening a trust, also open a company. Make that trust the owner of the company, right? There, what you are eliminating once you do that is death. A trust cannot die. So it means that the owner of the company will never die as a trust. So everything will always remain within the company. Then everything that you buy, your property, your cars, etc., they go into the company so that you can also avoid yearly taxes, basically. So what you do is that your trust will have trustees and it will have beneficiaries, right? Then the trust will own the company that will hold all your interests. This is for tax purposes. That will hold all your interests, right? Then what normally happens when I get technical, I don't want to get too technical, and tell me if I'm losing people, please. When it comes to year end, basically, how it normally helps you is that if your company creates a loss, it means that you're not paying tax that year. So that 27% you won't be paying it because your company is in a loss. And you can reinforce that loss for 3 years, basically. Which means that for 3 years, before you break even or you make profits, you don't need to pay taxes because you are reinforcing the loss if your company is making a loss, right? So let's take the scenario where that everyone is talking about now, where you just put everything in a trust. It means that each and every single time you get income and expenses in a trust, the trust is accumulating income, basically, it's active. So year end comes, and then you have to submit returns for the trust. What happens is that you find that the trust, for example, it has a profit of R1,000,000, let's say, because everything is in the trust, right? And there is no expenses going through the trust mostly. So you find that you have a net profit of R1,000,000. On that net profit of R1,000,000, SARS owns 45% of it, you know. But a company, even if you have a profit of R1,000,000, right, SARS will only have a stake of 27% of it, right? And that company is owned by a trust, so there's no need for changing of ownership of the company. If a shareholder of the company dies, there's no need for for the government to say that because they have died, they owned 27% of the company, so their 27% shares of the company needs to go into into estate, not estate, into what are these taxes once you die? Forgot the name of it now. My mind is thinking of a lot of stuff. But yeah, it goes into, sorry, into estate taxes. Let's just put it like that, right? It does not need to go there, right? Because the trust never dies, as I said. So that's why it is important to have your company owned by a trust. Then you operate everything out of a company to reduce your tax implications. As it was said earlier, I'm not sure who said it, but at the end of the day, there will be money going out. You just need to pick your struggle. If you go for a trust alone without any other structure, you will be paying high tax. Your property will be safe, basically, because it will transfer down to your kids, right? You just need to have your beneficiaries and your trustees. But this method that we normally use is far better because it also helps you on a yearly basis, basically, which means each and every single year you submit your returns. It's a matter of submitting your returns on the company because you won't be declaring dividends to the trust. So the company will only be operating on its profit and losses, basically. So yeah, I'm not going to be long, but it's just that if anyone wants to ask or anyone wants to add or subtract, they are welcome to.
I need to drop off. I needed to clarify that issue so that I leave it having clarified. The one for when someone passes on, right? And I'm going to, for those who love legislation, can always go and read. When you are dealing with the rollover that I mentioned, that when someone passes on and you have indicated that your surviving spouse is the one who's going to be inheriting your assets, the rollover is under section in 9 capital H capital B. You can read that section and have fun on it. Now, where it's actually dealing with, when I said when you passes on today, like I said, when you passes on tomorrow, we'll take the market value on the date of death. And then if you are transferring these assets to anyone other than surviving spouse, that's when I said the capital gain is going to kick in because you don't have any special benefits of rollover. And you can read that if you love reading You can read that on paragraph 40, subparagraph 1, capital A of 8th schedule to the Income Tax Act 58 of 1962. So you can have fun on that. You can tell it says to you, for an amount received or accrued equal to the market value of those assets at the date of that person's death, right? If an asset of a deceased person is treated as having been disposed of as contemplated in subparagraph 1 and is transferred directly to an heir or legatee of the person, the heir or legatee must be treated as having acquired that asset at the cost equal to the market value of that asset at the date of death of that person. Right. And this is a situation where we are dealing with this legatee or a heir not being a surviving spouse. So if you are acquiring that at market value, it means that deceased assets has acquired that asset at market value, which meaning that you don't have rollover provisions kicking in. You're gonna have to pay capital gain tax. But if it's a deceased, the person who's inheriting this is the surviving spouse, you'll find it under section 9 capital B, where it's actually giving you the rollover for what's this for rollover that you don't have to pay capital gain tax. That is the only thing that you're going to get when it comes to capital gain tax. I had to go back to the authority and coach you. So good night, and you're doing well.
I'm looking at that. Is it paragraph 40 something? I'm looking at, yeah, it says, okay, paragraph 40, subparagraph 1 of the 8th schedule to the Income Tax Act 1962. A deceased person for the period until the death
I
is
need to
treated
go
as
for
having
bed.
this.
Good night.
Thank you, Mr. Mutiba. Is treated as having disposed of his asset and the market value of the estate as a death. Okay, the death itself is deemed as a CGT disposal of assets, and thus in the deceased final tax return, this deemed disposal of CGT related assets would have to be reflected. The difference in value between the best cost of the assets and the market value thereof at the date of death is regarded as capital gain or loss, which must be reflected in the income tax return of the deceased as at the date. The exception to the rule is the particular instance if the asset bequeathed to the resident. Okay, should this be the case, the rollover. Okay, I'm not going to. The surviving spouse shall note that this rollover does not apply to a non-resident surviving spouse. It would not be applicable if I'm sorry guys, I just want to read this whole thing. Maybe I misinterpreted it. Related asset bequeathed to the spouse is sold out of by the estate, in which case calculations related to both deemed as an actual disposal would have been calculated and declared by the executor. Okay, whether asset is bequeathed the returns are there's no rollover capital estate surviving disposal, the period of death for the rollover does not apply. Okay, all right, maybe. Okay, I'm not seeing what I was talking about, so it could mean that I misinterpreted it. So Mr. Matiba was right. The only exception is a rollover, which applies to the surviving spouse. But maybe what we need to clarify, ke hore, the rollover, it's only applicable up until the death of the surviving spouse. Am I correct, Mr. Mutiba? So it's not like you are exempted. It's just postponed. Am I correct to say that it's just postponed? Because now when the surviving spouse dies and now maybe the assets are inherited by the kids, now the CGT kicks in when now all the parents have died. So it's not like it's something that they say they do away with it. They just postpone it. Oh, okay. All right. No. Yeah, I think Mr. Mutiba, thank you for that. I think I had misinterpreted the paragraph 40A. Because I thought that even the kids are exempted from paying the CGT up until they decide themselves to dispose of the assets. Yeah. Kunje, what else do I want to speak about in terms of the trusts?
Sorry,
Can
sorry,
I?
sorry,
Can, hello,
sorry
hello.
to interject. Ne?
Okay,
Okay.
can I go next after that? Okay,
Yeah,
thanks.
thank you so much. Thank you so much. I've been waiting as well. Because I just want to make everyone aware and note something. And